Hi, everyone. You probably noticed I'm not Maggie Lake. I am Harry Melandri, and today I'm talking markets with Andy Constan, founder and CIO of Damped Spring Advisors. Hi, Andy. It's a real pleasure to meet you, and thank you for taking the time to join me. And thanks, Maggie, for setting this up.
It's a joy. Thanks for having me, Harry.
Well, you're probably speaking too soon about it being a joy, but it's very good of you to be tolerant. So I'm crap at small talk. Everyone tells me Nixon had the same problem, apparently.
Uh-huh.
I'll tell you that anecdote later. So I had a lot to ask you about that report you forwarded to me, which I think is about 8 days old now. So let me quote you from it. What you wrote was, "We think long-term assets are unattractive, but recognize that a very dovish FOMC will cause further rallies in all assets. We do not expect the FOMC to be sufficiently dovish to support broad assets this week, but are willing to pivot if we are wrong." Was the Fed dovish enough to change anything for you?
No, absolutely not. The report was called "Can the Fed Out-Dove the Market?" And at the top, the simple way of determining what that is to look at the short-term interest rate market, the STIR market, in particular the SOFR curve, and which prices in the expectations of Fed cuts. And it's all backed up ever since the FOMC meeting, which means that market prior to the meeting expected more cuts than they do after the meeting. And so clearly they couldn't have been dovish if the market reacted, at least. So they were dovish, don't get me wrong. They cut interest rates and they lowered their dot plot. But the question when you're trading markets is relative to expectations, and relative to expectations, they were not adequately dovish. And so the bond market broadly sold off. Gold and stocks rallied. It's only been a week. Well, it's been less than that, 5 or 6 days. Equities are coming back a little bit, and gold took a big tumble this last 24 hours or so.
Mm-hmm.
But markets all in all, except for the very short-term interest rate market and the long-term bond market, and the dollar, notably, had priced in a Fed that was going to be more dovish, and they were less dovish.
Yeah, when I looked at the pricing in SOFR as I was reading the piece, and at the time I looked at it was 130 beeps. Right now it's 96 beeps, so it's definitely moving your way.
Yeah, the trough interest rate in particular, which is what you're really referring to, which is the level of rates where they're going to stop cutting, has backed up a fair amount. It had been below 3, and now it's above 3.
Yeah, exactly. And one question I always ask myself, though, when I'm looking at an apparent mispricing, because I'm an idiot and the market's very clever, it's very dangerous for me to fade markets, is how did we get to a place where the market was so one-sided in its pricing of risk? What caused that? Did you have any thoughts about how we got there?
Right. So I think it's firstly, let's step back and think about the macroeconomic conditions, and then also what is happening with the composition and the members' views about what's happening at the Fed. And we can start with this dilemma, which is still a dilemma and is not clear to anybody, that the 3 moving pieces regarding the economy that are the generally macro relevant moving pieces are the GDP, which is recovered a lot since the weak period in the first half of the year, and is printing. Some estimates are printing as high as 3%, even higher. The jobs market, which many are suggesting are slowing down. Some don't agree with that at all. And then lastly, the path of inflation, which I think there is universal agreement that the prints we're going to see in the next 3 to 6 months are going to be well above target and maybe stay substantially above 3% on an annualized basis. And so that's what the macroeconomic picture looks like. And so with that picture, you would expect strong GDP, high inflation, weakening labor market. There was no reason for the Fed to cut, and there was no reason for the Fed to cut steeply as they continue. Even they still continue to be priced a fairly aggressive cutting cycle, including 1 to 2 cuts this year and 2 to 4 next year, depending on how it all plays out. So there's still this idea that inflation is transitory, that the slowdown in GDP is the pickup that we've just recently seen will revert and will still be in a slowing below potential GDP, and that labor markets are actually weakening. And the Fed rarely, if ever, looks at its economic projections and has a radically different projection than everybody else that's looking at the economy, all the Wall Street analysts, all the investors. And so nothing changed regarding their economic outlook. And so what we've been hearing from the administration, who's very clear what they think, and an increasing number of Fed people who are not campaigning for the job of chairman, but are the middle ground, are all suggesting that while the consensus isn't changing much, the risks of a slowdown are increasing. And so when I think about that, I think, okay, we're in a cutting cycle, and that makes sense for the Fed to be transmitting that through its guidance and for the market to try to triangulate what that means in rates. And, we can talk about the backup that the Fed failed to outdove the market and the reaction in the bond market. But in plain fact, it's only a handful of basis points.
Right.
There wasn't a massive mispricing, and the market didn't get massively surprised. And so when I think about all those things going on, it's going about the way you might expect in an environment where there's some uncertainty, and the Fed, the independent portion of the Fed, is mixed with still some hawks that think the inflation's going to last and that the job market's fine. A preponderance of the independent portion of the Fed that is worried about the job market, and a handful of less independent members of the Fed, including the new member, Steve Moran, but also the campaigners, Waller, and to some extent Bowman, who are looking for the next job, are somewhat more dovish. And the administration is clearly suggesting that interest rates should come down a lot. Now, the one interesting thing about all that is the administration, at the same time they think interest rates are coming down, does not believe inflation is going to persist, which is consistent with interest rates going down, but does believe that the GDP and the job market are strong. And so they're a little inconsistent with what their desires are. So that's gotten, and this has been going on for 3 months now, that's gotten investors very hot and bothered about the idea of a run it hot economy. And in a run it hot economy, you want to be long stocks, you want to be short the dollar, you want to be long gold, and you really don't want to own the bond market, but you're okay with owning the front of the bond market because the Fed's going to cut aggressively.
Sure.
And so that pricing has developed over the last 3 months, consistent with that view. And the question is, will it manifest itself in that way?
And I took, from the piece, clearly you think that's run its course. And maybe clearly it's the wrong phrase, but you seem to think it's run its course. We've got that pricing in the price of various markets, fixed income, equities, and probably gold as well.
Yeah, I just shorted gold yesterday near the high, thankfully, and was lucky on that. And the reason why I short, and this is for my alpha account, I also own assets in my beta account and own them for life. I own gold. But speculatively, over the next 1 to 2 months, I shorted gold. I happen to be long short rates because I expect the Fed to cut more than is priced, which tells you that I think a slowdown is coming. And so my overall macroeconomic outlook is growth will disappoint. Again, everything's always relative to expectations. Will it be a recession? It doesn't have to be a recession. It just has to be worse than expectation.
Sure.
Inflation is likely to remain sticky, but in control and be transitory because the economy is weakening. And I expect jobs to weaken as well. And so in that position, you want to be short stocks as well. And I have a modest short in my book as well. And so that's my outlook, that over the next 3 months, we're going to see a weakening economy, a Fed that is going to cut more than is priced, but is not going to be extremely dovish. And I think most importantly, an administration that is pursuing aggressive anti-growth policies, which include immigration, which isn't increasing. It's, if anything, turning more negative.
Sure.
And with the H-1B visa thing, but also projections of negative employment growth that Steve Moran penciled in his most recent article. So that's anti-growth because there's less people. The number of people is actually shrinking that make stuff, and so you can't make as much stuff. And also there are fewer people to demand stuff, so you don't need to make as much stuff. But also inflationary to the extent that there's any jobs that need to be filled, there simply are no workers. And then tariffs, which it's interesting. The president thinks and really strongly believes that tariffs are good for the country, good for growth, because foreigners pay them. And so it's essentially a...
Does he really believe that?
Well, let me just describe whenever I say anything about people, I'm saying what they say, not what they mean or what they are, or whether we're being gaslighted or all those sort of things.
Sure.
But more importantly than what the guys are saying, the market is acting like these level of tariffs are good for bonds, good for stocks, and good for the economy. The market pricing suggests that all of the policies are, we're at all-time highs in stocks, relatively low interest rates, high asset prices broadly. Maybe tariffs are good. Now, in my world, tariffs are a tax that is paid by the world, and a significant portion of that tax is paid by the United States, its importers and its end client and its end consumers. Sure. And that is anti-growth. And the president's pursuing these policies. And so I don't think about the data. Like, a lot of people are like, well, show me the data that's saying we're having a slowdown. And I'm saying, I don't know. The data tends to be super lagging, and, it's hard to really interpret. And nowadays, the data is even more unreliable than it's ever been, for legitimately good reasons of resources being placed upon it, bad bureaucracy, you name it. It's not good. So I'm not going to be able to prove to you by looking in the rearview mirror that we're due for a slowdown. I'm thinking we're due for a slowdown based on looking in the windscreen at the approaching road and seeing anti-growth policies. And so that's sort of where my macro view is coming from.
Sure, it's useful. I was about to ask you to drill into growth, because I can see in the piece you sent, it says you're negative growth, but you didn't really explain why. But I think you just have explained exactly why. And it's interesting, I'm trying to write something now. I'm very slow when I write things. But I noted, I was chatting to a real estate broker in the area. I own multifamilies because I'm an idiot. Don't do it, kids. And he said to me, rents are falling in the Boston Metro. Now, how often have you seen rents fall? One of the times we saw rents fall was during COVID. There was a really good reason. Everyone was leaving the city, plague. But otherwise, you don't see rents fall on a sustained basis. You haven't in the United States. You didn't see it in 2008. There's a really good reason why you wouldn't see it in 2008. People couldn't afford to buy houses. and therefore, and they still wanted to live somewhere because, camping isn't as much fun as people make it out to be. So rents were pushed up. To get rents down, you need to see a declining population. And what's reported in the Boston press is that international students are not coming to Boston colleges.
Right.
It's one of the things. It's also reported by the real estate brokers talking to me that it's in the immigrant areas of Boston that you're seeing a decline in rents. And that can get a lot worse. And then we had that tricolor ABS issue that came up, where the FT reported that it was they were heavy into migrant populations, low credit migrants. Now, maybe that's because they can't work, because they don't want to get detained, or maybe it's because they went back to wherever with their cars. I don't know. But you're seeing preliminary evidence of something which would be consistent with declining growth. So I'm with you on this, and it's not my first go around. You may be able to tell that I'm a little older than some of the people on Twitter, and it's usually the revisions that tell us when things are going badly. We don't get it. We don't get early indications, and we just had a bunch of revisions, and they said there's 900,000 fewer jobs than we thought. So I'm with you on that. I can see signs of it, but we haven't had the confirmation yet. The other thing, another thing I was very interested in was you wrote about the convexity trade in mortgages in your piece, because you were saying that we're kind of fully priced in the belly of the curve. Yeah. It's expensive even. But what could justify that pricing? Well, a convexity trade. Can you go into that a little bit more? And have you heard any rumors about anything happening there? Because I have.
Sure. So what does that mean? Well, what the world owns, I don't know what the number is. Maybe it's $17 trillion of mortgages. And the Fed owns 2 trillion of that, and whatever the numbers are. Those are rough. And every investor who owns a mortgage knows that if interest rates fall a lot, their high yield mortgage, most of the mortgages in the world today are low yield mortgages trading well below par. But there's some mortgages that are trading that have a high yield that represent the mortgage origination that's occurred at these levels of interest rates. And as the interest rates, the new mortgage interest rate falls, you end up having your existing mortgage refinanced. And so they take your high coupon mortgage away from you and hand you cash. And so what's happened to you? You used to be long duration, you used to be long bonds, and now you're long cash. So what do you have to do? You have to rebalance and spend that cash, maybe on some of the new mortgages, maybe on treasury bonds, whatever it might be, to restore the exposure you desire. And so it's long been the case that when interest rates fall and mortgages shorten, there's demand for treasuries, which is interesting because there's already demand for treasuries that's caused interest rates to fall. And this is what we call negative gamma or negative convexity, which causes extra buying. And so we're not quite at a level where mortgage convexity has a meaningful effect. And also, some owners of mortgages just sit on their hands and say, okay, I have cash now. I'm not going to reinvest. I'm okay with not having as much duration as I do. And then some are active duration neutral hedgers. Those folks have to trade. Whenever interest rates fall, they're a buyer of bonds, which means buying at a high price. Whenever interest rates rise, they're a seller of bonds, selling at a low, sell high, buy high, sell low. Doesn't make sense, but they're getting an extra premium in their mortgage to pay for all those losses they're going to take. As time goes on and the amount of new coupon mortgages increases versus the old vintage stuff, it's moving very slowly, but faster than it has been. You're going to start to get these gamma flows, which will cause rallies in the 10-year note and really the 7 to 10 years where mortgages are priced and hedged, more demand as rates fall than you might expect. And so you can get a more aggressive rally on bonds during a period in which interest rates fall. And so is that priced? Well, it's never priced until it actually happens. It has to happen to cause the movement. But you can hedge some of that potential risk by buying bond options. And bond options are very, very cheap right now. Bond vol broadly. If you use the MOVE index, which is not the right thing to do, but if you use the whole bond cube, you're going to find interest rate volatility is relatively low versus recent history, which means
it's being crushed. It can't have been much fun.
And no one expects this rapid mortgage refinancing driven chase for bonds. So it's something I'm watching out of the corner of my eye, but it's possible that the 3 to 10 year sector, which is the richest part on the yield curve right now, meaning the lowest yields relative to the rest of the curve, is not only just pricing in a rapid cutting cycle that ends and pauses for a long time, but also maybe pricing in the potential of a rapid chase for duration if mortgages kick in. So that's what I put numbers around that in the piece.
So the reason I ask, and yeah, you stuck $1 trillion as a potential delta
for 100 basis points move lower. There's $1 trillion of duration that disappears from the market. Will it be chased? Not $1 trillion, but 100 billion at least. And that's a big number relative to things like QE and things like that.
Well, I looked at that and I put that together with some other stuff I'm aware of. So I've heard stories of the administration toying with the reprivatization of the GSEs.
Sure.
I've heard and of course, there's a fair number of people, scumbags like myself, who bought Fannie Mae preferreds because this was floating around. And one of the things you can say about Trump, which is extremely unpolitician-like of him, is he tends to deliver to his financial backers. Very unusually, because usually most politicians understand that a promise is worth more than a problem is worth more than a solution. Never deliver. So that's one thing. And secondly, there have been talk of the administration declaring a housing emergency. Now, I think this is spitballing, but I put the two of these together, and I think to myself, if they get this down another 50 beeps somehow, manhandling Fed officials in tax audits, perhaps. A tax audit is very persuasive. It would make me change my mind. If they were to do something along those lines, you could engineer that.
Or a real bond market squeeze.
A squeeze and pull rates down. And you might need to as well if you've got every sector kind of slowing down, with construction slowing down as well. Housing is a high multiplier. Residential construction is a high multiplier event, and people feel a lot better when they have locked in low rates than when they have locked in high rates.
Sure. I think what you're describing here is levers. The Trump administration has regulatory levers, coercive, and I mean that in a positive sense, if that can be a positive word, but
sure you do.
Coercive attempts to get interest rates lower. They want interest rates lower, and that's all well and good. And the question, and so there's levers.
Yeah,
and the Fed has its levers, and it may, but you have to then step back and say, okay, let's pull all these levers. Let's get interest rates low. Let's get mortgage yields low so that there's plenty of refinancing that'll stoke a further drop in interest rates as the gamma kicks in. That'll stimulate housing. That'll lower the cost affordability of houses because interest rates will be lower. assuming the price doesn't change. And so a manipulated economy, if you are able to manipulate an economy because you have a strong sense of where the economy is going and you need to deliver certain things so the economy doesn't get dramatically worse, and you're really good at it and you can time it right and you can know that can be a wonderful outcome for society. And that's really what the Fed is supposed to be doing. Are they doing it? They've screwed up a few times, to say the least.
That could happen to good people.
Has fiscal policy done it? Well, that depends on your politics, but I'm pretty confident that at least half the country thinks that both sides, at one side or the other, has mucked up the economy pretty badly. So these guys are just trying to do it. And so when I think about investing, I say, okay, what are they likely to do? And then what pressure valves are there? And what I would say is if we overstimulate the economy in whatever reason versus what is necessary. Now, if we have a slowdown, you're going to need to stimulate. But if you don't have a slowdown and you overstimulate, that's an interesting dilemma, because you're going to have pressure for interest rates to rise, not fall. You're going to have, if you then try to tamp down interest rates, you're going to have housing pressure to rise in price. Or if you tamp down interest rates and you do QE or yield curve control, then you're going to lose the US dollar. And so things like gold and Bitcoin and stocks are going to do well, but the US dollar is going to do horribly. And so when I think of the policymakers, firstly, an expanding economy broadly, because economies expand. Sometimes they contract when population falls, but in general, an expanding economy that grows based on population growth and productivity. And you've got all these forces that are trying to keep the bubble, and I don't mean an asset bubble, but keep the balloon optimally shaped. But they're constantly pushing on one edge or the other of that bubble, of that balloon. You're going to see some short-term bubbles develop as too much pressure gets placed on one thing, and that the pressure has to go somewhere. And so I think that's what we're in, an environment in which the way I would describe it is, I think we're in an environment in which policymakers are highly activist relative to price controls, interest rate controls, taxes, tariffs, spending, all of the levers, immigration, all the levers are being sort of shaken around a lot. And I don't think anyone's that good that they can predict the outcome. And so you have to say, well, what's priced, and say, what sort of levers is it really going to take for interest rates to fall a lot from here? Can they use those levers? And if they do, is there a hedge? Because you have to see where that pressure is going to go. And I think that's the dilemma facing markets right now. In aggregate, the way I look at aggregate markets and wrote in that piece, assets as a broad class, which includes gold, crypto, stocks, long-term bonds, just don't have much juice left. Corporate credit just don't have much juice in terms of forward-looking returns to say that you need to be aggressively long assets now. So I've been delevering my book. My long-only book is now 50% cash, which is the most cash I allow it to ever run, because I just don't see there's any, as a portfolio, all assets, I don't think there's adequate returns to hold assets at this stage.
That's quite a bearish outlook. And I'm not saying it's not justified. I can see really good reasons why it's justified. One of the problems.
Well, I don't know that you're right about that. Like, I'm bearish long-term assets, including bonds and stocks. That means I don't like assets, but I do like cash. It doesn't say anything about what I think about the economy. I happen to be somewhat bearish on the economy, which makes me more bearish stocks than I am bonds. But I don't think saying assets, broadly speaking, are that depend on growth and inflation, and each one differs. As a portfolio are overpriced. But
Okay.
call it what you will, that's what I have. All assets to me are somewhat overpriced.
Somewhat overpriced, and let's distinguish between somewhat overpriced and very overpriced, right? It's
Fairly
an
over.
important distinction.
I think there's very little forward return in
Right.
asset portfolio right now. I'm not trying to hide it. It's
No,
bearish,
no.
but I just want to make sure it like. So this is where cherry picking and people who will listen to this. If 4 assets fall in price 5%, say, and 1 asset goes up 10%, I don't care which it is. I don't care. I win when I'm short assets.
That's right.
But so I'm not picking, though I do think equities are the most overpriced relative to all. Well, gold's pretty darn overpriced relative to all the other things, and prefer bonds versus those things. In aggregate, I look at it and say, I don't have to make a choice. I can be short them all right now, or less long them all, which in particular is my posture.
Sure. I think we're out of time, but I wanted to ask one last question, which isn't really macro related. It's about your career history. You've worked at a lot of really interesting shops. What did you take from some of the places? What did different places teach you?
Sure. So I worked at Solomon Brothers for 18 years running equity derivatives when I left. And I took from that what most sell side people who have left take, which is bid offer spreads for moving large amounts of risk are very expensive. We got to eat we had to eat at Solomon Brothers. And so we took it through bid offer spread. And that's an important takeaway when you think about investing, how expensive it actually is to trade.
It costs money to trade. Yeah.
Right. And more importantly, even within a world in which there are zero commissions and narrow bid offer spreads, the sell side, in particular nowadays that the liquidity providers are Ken Griffin and others like him, they may provide you a very narrow bid offer spread that you think is attractive, but that's because they know which way you're going.
Yeah.
You know, right. if the fair market is 100 and they know you're a seller, they can make the market 97 at 97.01.
Sure.
And steal 3% because they know you're going to hit their bid.
I've had people complain about choice prices I've made. They said, "You read me."
I love choice prices. Choice prices are the best.
You read me. Of course I read you. Of course I read you.
Why do you think I offered you a choice price?
That's right.
Exactly. So that's number one. In terms of Bridgewater Associates, which was after I ran my own hedge fund for a number of years, I worked at Bridgewater Associates. In that case, the thing is so important is it is very likely that you don't have any edge at all. Like your expectation that you can beat the market should be extraordinarily low. Plus, they taught me about gold, which is a great diversifying asset. Brevin Howard brought me back to the street in terms of the actions of the type of people that worked with Brevin Howard were very sell side oriented. And I think what Alan in particular taught me is, one, if you're going to bet on something, really have something that you consider an edge, like really know that you can are the odds are in your favor in a major way versus what's priced. And then something he excelled in, which I think is very hard for most people to do, is when Alan had a view, he would buy tails or sell or buy upside tails if he was bullish and downside tails, and super leverage his bet so that if it paid off, he won.
It paid off big.
Right.
Yeah.
And I think that's an interesting thing. For me, the way I take that is throughout my entire career, buying tails is a disaster. Like, they are extremely badly priced for people to buy. And so, wow, Alan found a way to buy tails when they weren't expensive. And so I'm constantly on the lookout for cheap tails.
You always want. It's true. You always want asymmetric risk reward, and if you don't have to pay for it,
but most of the time you have to pay for it. That's the trick. In fact, most of the time you have to pay a lot for it. And so I learned that at Brevin Howard.
Fantastic. I think we're out of time, and I think we're meant to call it quits here. I could quiz you for hours, but I don't think your wife would like it. So, well, hopefully we do it again sometime. But it'd been great talking to you, Andy.